you all on the second class of live virtual classes organized by Board of Studies of ICAI. Friends, my name is CA Dr. Alok Garg and I am the today's faculty on this topic. Friends, this conceptual framework for financial reporting, is it a standard? Answer is big no. It is not a standard. It is something on which standards are based. So friends, this conceptual framework for financial reporting relationship with the Indian accounting standard is just like a relationship of alphabet to the apple, right? For example, when a child born and when a child started learning, studying, so the parents does not tell him only apple. Parents used to tell them A for apple, means alphabet comes before the words, right? Apple, boy, ball, cat, dog. So A to Z, A, B, C, D, E, F, G, H, A to Z is the alphabet, and through the alphabet, the words are formed, right? So likewise, conceptual framework for financial reporting sets the boundaries on which Indian accounting standards are based. So it's a framework, right? It's a fundamental principles which are used for development and drafting of Indian accounting standards, right? So it comes before Indian accounting standard. Okay, friends. So friends, before getting into this conceptual framework for financial reporting, largely it's a theoretical concept. Okay, I mean to say this chapter is a theoretical chapter. Okay, so you may find a question of 3 to 4 marks from this chapter. So talking about this chapter, friends, conceptual framework for financial reporting, it's a small chapter, right? It has around 8 to 9 units, 8 to 9 chapters. I'll take you through. But before getting into this session, let's discuss some quick questions. Friends, how many Indian accounting standards are there? How many Indian accounting standards are there? There are 39 Indian accounting standards. There are 39 Indian accounting standards notified as on date, right? 39 Ind AS. And when Ind AS were notified, Ind AS were notified on 16 February 2015. Okay. So friends, we have 39 Indian accounting standard which are developed, right, using the framework of conceptual framework for financial reporting. My dear friends, what are the component of the financial statement? What are the component of the financial statement? Because when you read conceptual framework for financial reporting, few component will be touched, right, in this chapter, in this conceptual framework for financial reporting. So my question to all of you is, how many component of the financial statement and what are the component of the financial statement? Friends, component of the financial statement is balance sheet, which provides you what? Which provides you statement of financial position. A statement of profit and loss, which provides you financial performance. A statement of changes in equity, which provides you shareholder performance, shareholder funds performance. Okay. Then your statement of cash flows, which provides liquidity performance, and notes to accounts, which provides the qualitative and quantitative information. So friends, our component of the financial statements are balance sheet, okay, then P&L, then statement of changes in equity, right, then it is cash flow statement, and then it is notes to accounts, okay, right? So balance sheet provides financial position, P&L provides financial performance, a statement of changes in equity provides shareholder funds performance, cash flow statement provides liquidity performance, and notes to accounts provide qualitative and quantitative disclosure. Okay. My dear friends, talking further, how many element of the financial statement and what are the element of the financial statement? So like there are total 5 component, right? There are total 5 component. So how many element of financial statements are there? How many element of financial statement and what are the element of the financial statement? Element of financial statement. In this framework, you will also read the element of the financial statement, the meaning of the element of the financial statement. वो पंच तत्व कौन से हैं? There are 5 element of the financial statement: asset, liability, equity, 3 from the balance sheet and 2 from the P&L, income and expenditure, right? So how many elements of financial statement are there? Asset, liability, equity, right? Income and expenditure, income and expenditure or expenses, right? These are the panch tattva of the financial statement. These are the panch tattva of the commerce world. So you discuss, you name, you think about any item commercially, it will get fitted into these 5 elements of the financial statement: asset, liability, equity, income and expenses, right? So these are the element of the financial statement, my dear friends. Friends, talking further, what are the 4 pillars of any accounting standard? What are the 4 pillars? So an item in the financial statement has to be weighed through what 4 pillars, right? For example, there is a fixed asset, there is a building which was purchased. So what are the 4 key items relating to that building? First, how that building is going to be recognized, in the books of accounts, right? At what value it is going to be measured, because if an item does not have any value, it will not be able to getting captured in the balance sheet, P&L, statement of changes in equity or cash flow statement, right? So first of all, recognition, then measurement, then where this building is going to be presented. For example, as a property, plant and equipment, as a first line item on the face of the balance sheet. Then what are the sort of disclosures which are required in respect to this building? For example, gross block, accumulated depreciation, net block, okay, impairment. If there is a revaluation related disclosures, okay. So these disclosures will be captured in the notes to accounts. Presentation is happening in the balance sheet, P&L, cash flow, SOC, it could be SOC as well, right? And my dear friends, the recognition means how it is going to be recognized, whether it has to be expensed off in the P&L or it is going to be recognized as a property, plant and equipment or investment property, right? And at what value, cost, revaluation, fair value, replacement value, okay? So value in use. So these are the various values, okay? So my dear friends, there are the four key pillars of accounting standard or any item, that is recognition, okay, R, then measurement, recognition, measurement, M, presentation, P, and disclosure, okay, D. Recognition, measurement, presentation, and disclosure. RMPD. Recognition, measurement, presentation, and disclosure, right? So far, now we have understood, we have 39 Indian accounting standards. There are 5 components of the financial statement under Ind AS: balance sheet, profit and loss, statement of changes in equity, cash flow statement, and notes to accounts. There are 5 elements of the financial statement: asset, liability, equity, income, and expenditure. And there are the 4 key items for any item in the financial statement: recognition, measurement, presentation, disclosure. My dear friends, you will read these concepts in the today's conceptual framework. Okay, is that clear? Great, my friends, great, my dear friends, absolutely fantabulous. Okay, so friends, talking about this conceptual framework for financial reporting, my dear friends, this conceptual framework for financial reporting sets as a boundary for development of Ind AS, right? For development of Ind AS, for revision of Ind AS, for providing guidance in Ind AS. So this conceptual framework sets as a boundary for development of Ind AS. Sir, like Indian accounting standard are notified by Ministry of Corporate Affairs wide notification dated 16 February 2015, whether this framework is also notified by Ministry of Corporate Affairs, my dear friends. This framework per se is not notified by Ministry of Corporate Affairs directly, but indirectly it is notified. Let me tell you how. Friends, this conceptual framework for financial reporting is issued by ICAI, and there is a reference of this conceptual framework in Indian Accounting Standard 8. There is a reference which is given, right? When I will teach you in AS 8, I will tell you how to develop an accounting policies in absence of any specific standard. Okay. So how to develop an accounting policy on an item where the standard is not there. For example, Bitcoin. Now somebody is asking how to do the accounting of Bitcoin. Okay. So the point is, my dear friends, the point is under Ind AS 8, the standard which talks about accounting policies, it gives a guidance that how the accounting policy is going to be finalized for an item where Ind AS is silent. It says that the framework needs to be referred, or the help of the framework needs to be taken for development of the accounting policy for such item. And what is that framework? That framework is a conceptual framework for financial reporting. So this framework is referred in Ind AS 8, and Ind AS 8 is notified by Ministry of Corporate Affairs. So my dear friends, indirectly it is notified, directly it is not notified. If you will search any notification where ministry has notified this conceptual framework, probably you will not get that notification. Okay, right? So friends, as we all know, our Indian accounting standard, Ind AS are the converged version. Ind AS are the converged version of what? IFRS, right? So Ind AS are the Indian standard, right? And IFRS are the global standard. IFRS are the global standard, my dear friends. Okay. So Ind AS are the Indian standard and IFRS are the global standard. Okay. So what we did, we developed our Ind AS taking IFRS as a base, and then we did some changes, very few changes, which are nomenclated as carve out, carve in, and removal of option. We discussed in the first class, right? Carve out means where under Ind AS we have taken a treatment different to what has been taken in the IFRS. To cut a long story short, we have taken a different treatment in Ind AS in comparison to IFRS. Carve-in, what is meant by carve-in? Carve-in means inserting or putting additional guidance. Inserting or putting additional guidance in Ind AS literature, which is not there in IFRS. Removal of option, as the name suggests, removing the option. In IFRS, two or more options are given, but we have curtailed those options and we said only this one thing will be applicable, right? So the difference between Ind AS and IFRS have been categorized into three parts, which is carve out, carve in, removal of option. My dear friends, like in IFRS, right? For development of IFRS, there was a conceptual framework for financial reporting. There was a conceptual framework for financial reporting under IFRS, which was issued in 2018, and this conceptual framework for financial reporting talks about development of IFRS standard, providing a guidance in IFRS standard. So like from IFRS we converged Ind AS. So likewise, from conceptual framework for financial reporting under IFRS, we developed conceptual framework for financial reporting under Ind AS in 2020, right? So we converged from conceptual framework for financial reporting under IFRS to conceptual framework for financial reporting under Ind AS, right? So one thing is very clear so far. This conceptual framework for financial reporting, as the name suggests, conceptual framework for financial reporting is not an Indian accounting standard. It provides a guidance for development of Indian accounting standard. It sets the boundaries for development of Indian accounting standard, right? It helps in finalization of the accounting policies when the standard is silent. It provides uniformity and consistency of the various accounting standard. Okay, let's move on, my dear friends. What is the agenda for this conceptual framework for financial reporting? Friends, in the first case, in the unit 1, we will cover the introduction of conceptual framework and the status, which we have already covered also, right? So then in the second unit, we will cover objective of general purpose financial reporting, GPFR, general purpose financial reporting. Then the third chapter is qualitative characteristics. We will cover the fundamental qualitative characteristics and we will cover the enhancing qualitative characteristics, right? So then we'll cover financial statement. What is meant by financial statement? Now you guys know financial statement means balance sheet, P&L, cash flow, statement of changes in equity and notes to accounts, and reporting entity. Who is the reporting entity? Who reports? Who publishes the financial statement? Standalone financial statement, consolidated financial statement. Then we will cover element of the financial statement. Are you aware about the element of the financial statement? Yes, sir. Asset, liability, equity, income, and expenses. Then we'll talk about recognition and de-recognition with the help of the example. Then we will cover measurement, right? So historical cost, current cost, fair value, value in use, replacement cost. So various type of replacement cost, various type of measurement. Then we'll talk about presentation and disclosure. Have we discussed recognition, measurement, presentation, disclosure? Okay. Then we'll talk about capital and capital maintenance. Capital and capital maintenance. Okay. For example, last, for example, your salary in the last year was 10 lakh rupee. This year, your salary become 11 lakh rupee. 10% increase is there, right? So if I talk about the in form, your salary has been increased by 10%. From 10 lakh, it become 11 lakh now, right? It increased by 10%. But tell me one thing. Let's say if inflation is 12%, if inflation is 12%, right? Last year you were earning 10 lakh rupee and now you are earning 11 lakh rupee while the inflation is 12%. So in spite of having an increment of 10%, will you be able to maintain your capital? Will you be able to maintain your capital? Yeah. Of course, no. So for maintaining my capital, right, for meeting my expenses on the current purchasing power, right, on the current inflation index, I need at least 11 lakh 20,000 rupees. But I have 11 lakh. It means my capital is getting deteriorated, right? Then friends, we'll talk about the key messaging and we'll discuss 10 multiple choice question to check your knowledge. Okay, let's move on. Let's move on, my dear friends. Friends, talking about the introduction, right? What is this framework all about? What is this framework? We discussed, my dear friends, the conceptual framework under Ind AS is not a standard, right? And does not override any Ind AS or any requirement in any Ind AS. So first of all, it is very clear to all of you, this conceptual framework is a guiding principle. It provides a guiding principle. It provides a format. It provides a layout. Okay. It is not a standard. It is not an Ind AS, right? And it does not override any Ind AS or any requirement in Ind AS. It does not override also, right? It is issued by ICAI, Institute of Chartered Accountant of India, and it is converged with IFRS conceptual framework, which was published in 2018, issued by International Accounting Standard Board, right? In case of departure, ICAI explained the reason in the appendix to the relevant Ind AS, right? My dear friends, you remember I told you in the first class, what is the structure of the standard? In the standard, first of all, there is a main standard. Main standard means standard. Then there is an alphabetical appendix. In alphabetical appendix, there are interpretations. Then there is a numerical appendix. Roman numerical appendix, appendix I, appendix II, right? What is this Roman numerical appendix? It provides the difference between Ind AS and IFRS. Okay. So friends, In 1989, so International Accounting Standard Committee long back issued the framework for the presentation of the financial statement, framework for the preparation and presentation of financial statement, and ICAI was also using that framework for the preparation and presentation of financial statement. In 2018, International Accounting Standard Board had revised this framework for preparation and presentation of financial statement to conceptual framework for financial reporting under IFRS. Likewise, in 2020, Institute of Chartered Accountants of India also converged IFRS conceptual framework to Ind AS conceptual framework, right, in 2020. What was the purpose? Now we all are aware the purpose. The purpose is to assist Institute of Chartered Accountant of India in formulation of Ind AS based on the consistent concepts. Okay, friends, there are five brothers. Whether all the five brothers will be same, I mean to say same in their thinking, same in their thought process, whether all were same? Answer is no. But if five brothers have taken a birth in the Brahman community, for example, and their father is the devotee of the Lord Shiva, for example, right? So these five brothers, since birth, they have seen their father to worshipping Shiva, Lord Shiva, right? Means their father is very religious, very devotee, right? A pure vegetarian person. So likewise, these five brothers will also follow the religion, the religion, the custom of the house, right? And probably these five brothers will be, right, they will be vegetarian, they will be kind of, they will be kind of God-fearing person, right? They will be kind of devoting and worshipping person. So the point is this father is giving the directions to the five sons. Okay. So this conceptual framework is just like a father to the Indian accounting standards, right? It assists ICAI in formulation of Indian accounting standard based on the consistent concepts. Let me take an example of consistent concepts. My dear friends, whether the financial statement has to be prepared on a cash basis or accrual basis, what is the general feature of the financial statement? Cash basis or accrual basis? Accrual basis. Accrual basis means transactions are going to be recorded when it will be incurred, not on the basis when the cash is received. Okay. Accrual basis means transaction is going to be recorded when it is incurred, right? So friends, now if I talk about 39 Indian accounting standards, all these 39 Indias touches the different concepts. Okay. For example, revenue recognition. Let's talk about revenue recognition. Ind AS 115, right? So Ind AS 115 says that revenue has to be recognized to the extent the probability of collection is certain. The probability of collection is certain. Okay. For example, a company has sold goods to a customer for 1 lakh rupee. The company is expecting that it will be able to collect 80,000 rupees only, right? So whether revenue will be recognized for 1 lakh rupee or 80,000 rupees, revenue has to be recognized to the extent the probability of collection is certain. So revenue has to be recognized for 80,000 rupees, right, at the time of the sale. So subsequently, of course, when the degree of certainty will go higher, for example, after 2 months or after 1 month, now the entity is certain that it will be able to recover 90,000 rupees. Then 10,000 revenue has to be recognized at that point of time. So my dear friends, what is this concept? This concept is a cash concept, or this concept is an accrual concept? This concept is an accrual concept. You are not saying revenue has to be recognized on the collection basis. You are not saying that. You are saying revenue has to be recognized to the extent probability of collection is certain. Okay. So means you are not waiting for the collection. You are not waiting for the cash to be in. You are waiting for the certainty. Okay. Second example in the actuarial, right? Ind AS 19 employee benefit standard says that the provision for gratuity or long-term employee benefits like leave encashment has to be measured on the basis of projected unit credit method, right? Means every year you have to measure, you have to recognize your provision for gratuity. Doesn't matter whether employee will leave or not. I mean to say, the gratuity has to be payable only at the termination or attrition of the employee, right? It will be only payable at the exit of the employee. Gratuity will never be paid. Gratuity will never be paid during the continuation of the tenure of the employee. No, never. Gratuity will only be paid after exit of the employee, right? So Ind AS 115 is a revenue standard which talks about the accrual concept. Ind AS 19 employee benefit standard, it also talking about taking a provision when employee is providing a service. It is also taking about accruing the provision. Now Ind AS 37 provisions, contingent liability and contingent asset. Ind AS 37 says that provision has to be measured on the basis of best estimate. Means you are not waiting for the outflow. You are creating a provision right now. Right? So my dear friends, if you see every standard for the purpose of recognition and measurement, wherever recognition and measurement is there, the standard is talking about the accrual concept. The standard is not talking about the cash concept, right? So the general feature of the financial statement is it has to be prepared on an accrual basis. How the financial statement has to be prepared? Financial statement has to be prepared using Indian accounting standard. So see, you have to prepare a financial statement, okay, on accrual basis. Accrual basis. You have to prepare financial statement using Ind AS, right? And there are 39 Ind AS on different topic. So when you are using Ind AS, it means these Ind AS should be on accrual basis, right? So from where these Ind AS are coming? From where these Ind AS are coming? Conceptual framework. And this conceptual framework has given a fundamental concept of accrual basis, and all the standards are drafted on a accrual basis in terms of recognition and measurement. Okay. Consistent preparation. These framework also assist preparers, management to develop consistent accounting policy when no Ind AS applies or where a choice is allowed. My dear friends, have we discussed this? Right? When no Ind AS is there, then this framework helps the management to finalize an accounting policy. Or whenever there is a choice, there is an option, right? This framework also helps that you have to use that accounting policy where it provides the relevant and the faithful representation of the information, right? Interpretation of Ind AS, it assists all the parties like preparers, which is management, auditors, users, regulators to understand and interpret the standards. So my dear friends, the conceptual framework helps in the setting of the standards. It also helps in the consistent preparation, right? Consistent preparation means when there is accounting policy choice, how it is going to be used. When there is no Ind AS on any item, how the accounting policy has to be finalized or developed, right? And it also assists, it also provides guidance on the interpretations of Ind AS, okay? Now, let's come to the second chapter of objective of general purpose financial reporting, right? Sir, how you have unitized these units? It is on the basis of your board of studies material, okay? So what is the objective of general purpose financial reporting? First of all, financial reporting means publishing and finalizing the financial statement. Financial statement means balance sheet, P&L, cash flow, statement of changes in equity and notes to accounts. Sir, what is this objective of general purpose financial reporting, GPFR? Financial reporting we understood. What is meant by general purpose? For example, Mr. Mukesh Ambani asked his CFO that please give me a balance sheet where you have to show trade receivable as the first line item. Okay. And top 5 trade receivables in the first line item. Then in the second line item, other trade receivable. Then third line item should be property, plant and equipment only relating to Jamnagar refinery plant. And in the fourth line item, the other property, plant and equipment. Mr. Mukesh Ambani is providing some guidance to the CFO. So friends, whether CFO will prepare such balance sheet for Mr. Mukesh Ambani? Answer is yes, he will prepare, but he will not say that it is general purpose financial statement. He will not say that it is general purpose financial reporting. It is a customized, special purpose, MIS related balance sheet, okay? Only for the purpose of the consumption of Mr. Ambani. Now, myself, Karan, Monica, right? Samaksh, Midhavi, we all are the shareholders. We all are the shareholders of Reliance Industries Limited. Can we ask such balance sheet from the CFO of Reliance Industries Limited? Or whether the CFO will provide such balance sheet which he has provided to Mr. Ambani? Answer is big no, right? So general purpose financial reporting is something which has been prepared as per the applicable law, framework and the Indian accounting standards. Okay. So which is helpful for the regulators, creditors, lenders, shareholders, analysts, okay, bankers, employees, customers, which can be used by the public at large. For example, annual report. So for the listed companies, the financial statement in the annual report is public information once it is getting published. For unlisted companies, you can also get the financial statement in the XBRL format by paying some fee, 118 rupee or 108 rupee to the MCA. Okay. So what is the objective of the general purpose financial reporting? The objective is to provide the financial information about the reporting entity which is useful to the existing and the potential investors. So the current investors which has invested in the company and potential investor also, right? Today, I want to invest in the shares of Reliance Industries. I am not a shareholder of Reliance. I want to invest in the shares of Reliance. Guys, see what sort of guidance I will use for taking a decision whether I should invest or I should not invest. The first primary document is financial statement, right? Financial reporting, financial statement. So the objective of the general purpose financial reporting is to provide the useful financial information of a reporting entity which is benefited to the existing investors, potential investors, lenders, which is bankers or financial institution who are providing the debt to the company, okay, lenders, and other creditors in making decisions relating to providing resources to the entity. So friends, how the entity will get the blood? When I say blood, blood means resources. Resources means funds. How the company, from which sources the company will get the funds? So the company will get the funds from two sources. Number one, equity. Number two, debt, right? Equity and debt. So the investors invest money in the company, right? Number two, the banker, the financial institution, or the service provider who is providing the goods and service on credit basis, right? So lenders and creditors provide debt or the goods and services on a credit basis, right? So these investors, lenders and creditors provides the resources to the entity. Okay. So whether these investors, lenders and creditors have to provide the resources to the entity, of course, they need some information, useful information in taking a decision whether I should provide or I should not provide. For example, you have applied a personal loan. Tell me, for giving a personal loan to you, what sort of document bank will require? Bank will require your salary slip. Bank will require your income tax return, right? So these are the useful information. Bank will require your civil score, whether you have defaulted in the past or not. Bank will require your ID proof, address proof. So bank will need all the useful relevant information to decide whether bank will provide a resource to you or not in the form of a loan, right? Those decisions involve, what could be those decisions? Buying, selling or holding equity and debt instrument. So using those financial statement on a quarterly basis or a yearly basis, these investors will decide whether I should buy more. I mean to say whether I should invest more in this company or I should exit from this company or I should keep the equity and debt instrument in this company. The banker will decide, lender will decide whether I should provide or I should settle loans and other forms of credit, right? So exercising rights to vote on or influence management actions. The investors The shareholders will decide whether I need to exercise my right to vote or influence the management actions, right? What is the correlation between the general purpose financial reporting and the user's decision making? Financial information, right? About economic resources, claims, and changes. So when you look at the financial statement, it provides you the details, it provides you the details of asset, liabilities, and equities. It provides you information about the economic resources. It provides you the details about the claims. Claims means equity share capital and the liabilities, right? Claims means liabilities. Okay. Okay. And the changes, it also provides you through your statement of changes in equity and through your statement of profit and loss. It also provides you the changes in the performance. Okay. Assessment of amount, timing, and uncertainty of future net cash flows, right? So these general purpose financial reporting also provides the details of provisions, right? So provisions are not actual amount. Provisions are the liability of uncertain timing or amount. So when you look at the accounting policy on the provision in the notes to accounts, we says that the provisions has to be measured on the best estimate basis. Okay. So then the notes provide you contingent liability also. So these kind of, items provide the users of the financial statement, the lender, regulator, banker, investor, okay, and the creditor in assessing the amount, timing, and uncertainty of future net cash flows. Expectation of returns, dividends, principal interest, price gains, etc., etc., and the decision of investors, lenders, and other creditors. So these things are based on these aspects. For example, the company has lot of contingent liability. Then the lender will expect in the future the profits may go down. Why? Because there could be some item which may be confirmed, which may be converted from contingent liability to confirmed liability, right? So the investor will assess whether it will be a risky business to invest or it will be a fair price business to invest, right? So these items provide and helps in the decision making of the user of the financial statement, right? What are the limitations of the general purpose financial statement, my dear friends? General purpose financial reports do not and cannot provide all the information needed by the users. Users must also consider general economic condition, political event, industry outlook. Okay. For example, a company, a company is a company is I would say die-hard supporter of Congress in a state. I'm just taking an example. So a company is a die-hard supporter of Congress party in a particular state. So the company is making a huge profit. The Congress party is in power in that state, and the company is flourishing and doing great. Right. So the elections will come in 1 year, and in that state, it seems like that the Congress will go and BJP will come, for example. So the company is not a supporter of BJP because one of this company is led by one of the MLA who is a Congress MLA, for example. So when BJP will come or some other party will come, probably this company will face a lot of hurdles and problems in getting awarded the infra projects, right? Or running their business smoothly. Yes. Okay. So the point is, but these kind of events, right? These kind of events, whether if the election will happen, the party will change, what will be the impact on the business? These kind of event situations are not described in the financial statement. So financial statement does not provide you all the information. General economic condition, geopolitical risk, industry outlook, political events. So these are not part of the general purpose financial statement. So while few bit of it is the part of MD&A, management discussion and analysis section of the annual report. Okay, not the financial statement. So general purpose financial statement are not designed to show the value of reporting entity. They help users estimate that value. Okay. Startup, right? So now the Byju's, you know about Byju's, right? What is their fate and what happened with Byju's? So I still remember, couple of years back. So Byju's has a valuation of $2 billion, $3 billion, XYZ billion dollar. So even the loss making unicorn startup, they have a valuation like anything. So what you will look at in the balance sheet, in the financial statement, you will look at the financial position, the current position. You will not get the value of the reporting entity, right? So there could be a situation where entity is making a loss, but the entity has a valuation of, let's say, $10 billion, $5 billion, $2 billion, right? Right. So the point is the financial statement does not provide these sort of information. These are not primarily directed at other parties, right? Regulators, general public, other than investor, lender, and other creditors. So friends, who are the primary users? So general purpose financial statement, the primary users users of general purpose financial statement is investor who is existing and potential, lenders, right, and the creditors. These are the primary user of the general purpose financial statement. Other than these three, like customer, employees, regulators, right, others are the secondary user of the financial statement, right? Largely financial statement are used by the investors, lenders, creditors. Okay. Yes, now moving further, my dear friends, what information is provided by the general purpose financial statement? Financial position and financial performance. Financial position means assets, liabilities, and equity. Assets provides the economic resources. What is an asset? Asset is a resource controlled by the entity resulting from the past events, right? So your financial statement provides the financial position, which provides the economic resources, which is nothing, assets, and the claims, which is liability plus equity. Who will claim? Either the lender will claim, lender and creditor. Whatever liability is there, it has to be bifurcated into two parts, either lender or creditor. Sir, employee, it could be employee also. My dear friends, if there is an outstanding payable to employee, if there is a salary outstanding payable to employee, where it will come into the balance sheet? Trade payable or somewhere else, it is trade payable, right? So on the liability side, either it is debt or it is creditor, outstanding amount for goods and services, right? So then equity, investor who has given their money, they also expect the returns and the returns on the capital and return of the capital, right? So your financial position provides economic resources and the claims. It helps assess liquidity, solvency, need for additional financing, and management stewardship, right? So my dear friends, this financial position provides the clue, the guiding principle to the investors and the lenders about the liquidity position of the company, about the solvency of the company, debt equity ratio, debt service coverage ratio, interest service coverage ratio, profitability ratio, for example, right? And whether the company need additional financing or not. For example, if you look at the financial statement of Vodafone Idea Limited, every investor is saying, everybody is saying Vodafone Idea Limited is in the need of additional financing, and even they themselves say our fate is depending on the additional financing, right? Change in resources and claims. What is change in resources and claims? Change in resources and claims talks about your statement of profit and loss, talks about statement of changes in equity and statement of cash flows, right? Financial performance, it provides financial performance, right, which is on the accrual basis, which comes from P&L. Your cash flow statement of cash flow, which provides you what is the cash generation from the operating activity, what is the cash generation from the investing activity, what is the cash generation from the financing activity. Okay. Then, my dear friends, it also provides the non-performance changes, right? For example, issue of debt, equity, right? So while if there is a buyback of capital, there is a issue of right, there is a right issue, right? There is a right issue means issuance of capital. So payment of dividend. So these will not come to your P&L, but this will come to your statement of changes in equity. Okay. So accrual accounting reflect effects even if cash occurs in a different period, right? So this talks about accrual accounting. As I told you, accrual accounting means accounting when the transaction is incurred, not when the cash will be received, right? So my dear friends, we talked about the introduction of the conceptual framework. We talked about the meaning of general purpose financial reporting, right? Who are the primary user of the financial statement? Lender, investor, lender, and creditors, right? How the financial statements are helping these investor, lender, and creditors, right? By giving them financial position about the economic resources and claims, which is asset, liability, and equity, and by providing the changes in resources and claims through the financial performance, which is P&L, through the cash flow performance, which is through cash flow, and the non-performance changes, which is through statement of changes in equity and notes to accounts as well. Third unit is very important. Qualitative characteristics. My dear friends, qualitative characteristics means what makes financial information useful. The auditors are writing the financial statement of XYZ Limited are presenting true and fair view as it has been prepared using Indian accounting standard as notified under section 133 of Companies Act 2013. How come using an Indian accounting standard makes presenting the financial statement true and fair? So how come the financial statement reflecting true and fair view just by using the Indian accounting standards? Just by using the Indian accounting standards. My dear friends, because the guiding principle is coming from conceptual framework, and conceptual framework provides what could be the quality, what could be the qualitative characteristics of the financial statement, qualitative characteristics of the financial statement, right? Just a minute. Means what makes financial statements useful, right? What makes financial information useful? So it talks about two kind of qualitative characteristics. FE, fundamental qualitative characteristics, and enhancing qualitative characteristics, right? Fundamental, basic, and enhancing qualitative characteristics. So both are required for information to be useful. Fundamental, there are two kind of fundamental qualitative characteristics: relevance and faithful representation. The financial information in the financial statement has to be a relevant information, and it has to be represented faithfully. Now, how will you say that a financial information is a relevant financial information? So financial information has to be considered as a relevant financial information when it is based on the concept of materiality, right? Tell me one thing. Reliance Industries Limited, let's talk about the company. Last year, the consolidated turnover of this company was 11,76,000 crores. In the first quarter of this year, they crossed a turnover of 3 lakh crore. Are you getting me? 3 lakh crore. So if I talk about the number 3 lakh crore, so how it will be look like? 3 lakh crore. This is the number of the turnover of Reliance, okay, in the quarter one. My dear friends, last year they have the top line consolidated turnover of 11,76,000 crore and the bottom line of 95,000 crore, profit of 95,000 crore. Tell me, a small item of 50 lakh, 1 crore, whether it will make any difference to the primary user of the financial statement? Let's say Reliance has invested 50 lakh rupee on an advertisement, and the accountant has forgot to record that advertisement expenses. Will it make any difference? Will it make any difference, my dear friends? It will not make any difference in the share price, in the earning per share, in the decision making capacity of the user of the financial statement. They are rounding off their numbers in crores. They have a huge top line, huge bottom line. The level of expenses are huge. Even so, they are the conglomerate. And since they are the conglomerate, right, even their small business has a value of 40,000 crore, 50,000 crore, right? So the point is, if the concept of relevance will not be there, I mean to say, if you will not apply the concept of materiality, probably your notes to accounts will be 500 pages, right? So normally our financial statement are maximum, if it is a big company, one of the largest company, the financial statement are of a size of 80-90 pages, right? But tell me a situation, if you will not apply the concept of materiality and you will start recording every expense as a separate line item, probably your financial statement will comprise 200-300 pages. If you start explaining every item, and what happens if you start explaining every item, sir? So as a student, as a small kids, you will be thinking, sir, don't you think that will be a good disclosure? So everything is going to be disclosed. Tell me one thing, you have to pass CA final exam, right? And you have to clear a financial reporting paper. In your financial reporting paper, only Ind AS is there. If ICAI will cover, if ICAI will include entire US GAAP, entire IFRS, entire Ind AS, entire accounting standard, right? In your FR syllabus, will you able to concentrate and focus only on Ind AS? Of course, no. Of course, no. Right? So, friends, that's how, if every small information will become the part of the financial statement, the relevant information and the critical information may be missed while reading and analyzing the financial statement. That is why the framework says that for making, framework says that the fundamental characteristics, the fundamental qualitative characteristics of the financial information is it has to be relevant. For becoming a relevant, it has to be material. It has to be material financial information. Material amount has to be there, and it provides predictive value as well as confirmatory value. It provides predictive value as well as confirmatory value. What is meant by predictive value and confirmatory value? Predictive value means, your financial information, financial statement does not provide any forecast, budget. It provides the actual information. It provides balance sheet as at 31st March 2026. It provides the information of the past, right? So statement of profit and loss for the year ended, not for the year ending, year ended 31st March 2026. Okay. It provides the actual information, but using those information, right? Current year, comparative year, right? The investors, lenders, creditors, they are able to predict the future outcomes, right? They are able to predict the future outcomes. For example, normally if you have heard, if you if you read or if you listen any business news, you must have heard the analysts are forecasting a earning of 10% over the top line. They are budgeting and forecasting a increase of 7%, growth of 7% in the top line over the last year performance, over the last year turnover. Okay. So basically your financial statements are in such a manner that it provides a predictive value, so that user will use those information, user will predict the future outcomes. Okay. What is a confirmatory value? So confirmatory value means confirms or changes previous evaluation. For example, on the basis of predictive value of the last year, so last year the company has published the financial statement of 31st March 2025, right? There was a growth of 10%, and using all the information, the user believes, the primary user, the investor, lender and creditor believes this year also the company will have a minimum growth of 10%. Okay. So when the financial statement came on 31st March 2026, whatever they predicted, whether the actual coincides with the predictions largely, substantially, then they will say that it confirms, the actual outcome confirms our expectation, or we need to revise our expectation. For example, their expectation was 10%, but when the result was published, so the turnover was in the growth was only 5% due to the geopolitical factors. So now they are revising their expectation. They are thinking that this America and Iran war is not stopping. So nowadays the war is like a, Mario game. It never stop. It is like a subway surf. It never stop. Okay. So lot of modules are there. Like this Russia, Ukraine. Okay. So America, Iran. So these kind of wars are keep on going and going, right? So now on the basis of the actual outcome, on the confirmatory values, now the investor and analyst are revising their expectation. Okay. So basically, the information will be considered as relevant, right? When it will be able to provide predictive value and confirmatory value. It will be able to provide both. Predictive value means the user will be able to predict the future outcomes. Confirmatory value means the user will be able to compare what they have predicted in the past, whether the actual outcome coincide with the past or not. For example, they expected a profit of 500 crore for this year. When the actual outcome came, the profit was 490 crore, means largely aligned. But if the profit is 300 crore, it means their expectation has not met, so they will revise their expectation. Example, revenue information for the current year can be used as a basis for predicting revenue in the future year. It is a predictive value. It can also be compared with revenue prediction made in the past years for the current year, right? The comparison helps the user correct and improve the earlier prediction process. It gives a confirmatory value. Okay. What is materiality? Information will be considered as material if the omission, misstatement, or obscuring can impact the decision making capacity of the user of the financial statement. Okay. For example, contingent liability. While it is not a confirmed liability, but there was a huge demand order came to the company, right? So there was a contingent liability of 500 crores. Okay. So the company has not disclosed the contingent liability because the company believes that this is not an actual liability. We are fighting in the court of the law. So the company has not done any assessment and the company has not disclosed the contingent liability. My dear friends, tell me one thing. If the company would have disclosed the contingent liability, whether it will not impact the decision making capacity of the user of the financial statement, it will. It will. Even when the valuers will do the valuation of the contingent liability, valuation of the entity or the business, they also factor some part of the contingent liability as their main liability. Okay. So information will be considered as material if the omission, misstatement, or obscuring can impact the decision making capacity of the primary user of the financial statement, right? And materiality is largely entity specific, right? For example, for Reliance, 1 crore is not material, but for us, 1 crore is a huge amount. Okay. So ICAI cannot specify a uniform quantitative threshold for materiality, nor predetermine what could be material in a particular situation. My dear friends, the guidance of materiality is a subjective guidance. It is not an objective guidance. Okay. No any threshold is given. The materiality is an entity specific materiality. Okay. Right. So judgment is required for each entity based on the nature and magnitude of the item. Right. So friends, first of all, the first fundamental characteristics was relevance, and the information will be relevant if it is material and it provides predictive value and confirmatory value. And the another fundamental characteristics is the information has to be represented faithfully. The information has to be represented faithfully. Means, right? Faithful representation means, so the faithful representation will be achieved by ensuring that the substance over form has to be ensured. Complete information should be complete. Information should be neutral and free from any error. Information should be neutral and free from any error. Let's discuss this. To be useful, financial information must faithfully represent the substance of the situation. If substance and legal form differ, providing only the legal form would not be faithful. Let me take an example, my dear friends. Ind AS 116, when you read Ind AS 116, okay? So leases standard. Few of you might be knowing, in our accounting standard, when there is an operating lease AS 19, it says that you need to record your rental expense and credit your bank, right? You need to record your rental expenses. But in case of Ind AS 116 leases, technically speaking, if you would have taken a loan and you would have purchased a house, you would have shown house as an asset and loan as a liability. And what you are getting a right to use that house. If you have taken a house for 3 years lease, for a lease period of 3 years, don't you think you have also entered into committed obligation for 3 years? And what you are getting a right to use of that house. So going by the substance, you are getting some right and for which you are paying. So my dear friends, in Ind AS 116, when you read this standard, it says that all the leases has to be measured on the basis of present value of the future lease rentals. So you have to discount all the future lease rentals. Whatever value will come, you have to recognize right of use asset and you have to credit lease liability. So Ind AS 116 is a classical example which is based on the substance over form. So going by the form, it is a leases, but going by the substance, right? It is going by the form, it is rent. Going by the substance, you are paying for using, you are paying for getting a right of use of the asset. Okay, ROU. Second, preference share capital. In India, either a preference share capital could be convertible preference share capital or could be redeemable preference share capital. You will find a lot of private limited companies, what they are doing, they are issuing a redeemable preference share capital. Okay, they are issuing. So friends, in our accounting standard, we were showing this redeemable preference share capital as a capital. Is it a capital? What is a capital? In capital, you have always a residual interest. But this preference share capital has to be prioritized before the equity share capital, right? So going by the form, the word is preference share capital, but going by the substance, it is like a borrowing. So in Indian accounting standard, as per Ind AS 109 and 32, this has to be classified as a debt, not the capital. Ind AS 115, another classical example of substance over form. Guys, a lot of example I have taken. Ind AS 116, substance over form. Ind AS 109, 32, 109, 115. Another example of substance over form. For example, you have said you are an automotive company. You sold a car and you are also providing 3-year free service, a free service for 3 years. You took 10 lakh rupee from sale of the car from the customer. Friends, this 10 lakh rupee is only for the sale of the car, or this 10 lakh rupee is for the two performance obligation. One, sale of the car. Second, providing free service for 3 years. Don't you think when you provide service to this customer, you also incur cost, right? So Ind AS 115 says that whatever money you have received from the customer, whatever consideration you have received from the customer, that consideration has to be allocated to the various performance obligation. So going by the substance, while you receive the entire 10 lakh rupee, but you have not delivered the entire performance obligation. You have only delivered car. Please record the revenue relating to the car and keep the liability for the portion of the services you are going to provide for next 3 years. And whenever you complete the services or the time will elapse, what you have to do? You have to recognize revenue and you have to debit liability and recognize revenue for that portion. So first, the faithful representation will be achieved to apply substance over the form. Second, the information has to be complete, right? Means it includes all information necessary for the user to understand the phenomenon, including description and explanation. Friends, the company has a property, plant and equipment. Okay. Last year, the company has a property, plant and equipment of 1 crore rupees. And in the face of the balance sheet, only PPE will come. And what is this PPE? Is it a gross block or net block? This property, plant and equipment is net block, which is gross block minus accumulated depreciation. It is the net block. Okay. It is the net block. Friends, last year it was 1 crore rupee. This year it become 1.25 crore rupees. Or let's say 2 crore rupees. From 1 crore it become 2 crore rupees. So on the face of the balance sheet, This is the last year, this is the current year. The PPE was 1 crore in the last year, current year it become 2 crore. Looking at the face of the balance sheet, what is the thought which come into your mind? Sir, this company has doubled the property, plant and equipment. This company is doing expansion. This company has acquired capex. This company has purchased capital asset, fixed asset. But you know what this company has done? This company has done the revaluation. This company has applied the revaluation model, and this company has revalued the fixed assets, and due to revaluation the amount has been more than doubled. So even after depreciation, right, and after revaluation the amount got doubled. So tell me, if the company will just provide on the face of the balance sheet this kind of figures, and the company will only provide the gross block, ECDEP and the net block, and the company will not provide all the necessary information relating to the revaluation, will the information will be considered as a complete? Will the user of the financial statement will be able to take the proper decision? Answer is no. Okay. So complete depiction has to be there. Complete depiction. For example, a complete depiction of a group of assets include nature of the asset. When you look at the PP&E schedule, you will find office equipment, land, building, furniture and fixtures, aircrafts, okay, plant and machinery, okay, numerical amount, gross block amount, accumulated depreciation, net block amount, and what the numerical also need explanation of significant facts. For example, for borrowing, you are providing what is mortgage. Always you are depreciating other parties. What does it mean? It means you are not neutral, right? It means you are not neutral. You are biased towards one party. Okay. So guys, likewise, information should be neutral. Information should not be with any biased, right? For example, you have opted a revaluation model. Okay. And what you said? You said this revaluation model is the best model, and hence the company has applied the revaluation model for revaluing the property, plant and equipment. Your information has to be neutral. It has to be fact-based. Fact-based means you can say that the company has elected to opt for revaluation model because there is a huge increase in the prices in comparison to the historical cost, and company wants to reflect the current market situation in its financial position, because now the company become big and bigger. So you have to justify, you have to give the relevant facts and the basis, so that the information will be neutral and the user of the financial statement can analyze and interpret the financial statement or the information using their own wisdom, right? It has to be neutral, without bias in selection or presentation, supported by prudence, right? Caution under uncertainty, asset or income not overstated, liabilities or expenses not understated, and vice versa. Okay. So your assets and income should not be overstated, liabilities and expenses should not be understated. If there is any uncertainty, you have to provide the proper explanation. Okay. So in your presentation, so for example, you should not use bold or the large fonts for the large items. Okay. So it has to be consistent and neutral. And of course, the information has to be free from error. There should not be any error in the qualitative information as well as quantitative information. No error in description or in the process used, free from error, perfectly accurate, reasonable estimates are acceptable, right? So while if there is, for example, provision for gratuity, provision for warranty, provision for asset retirement obligation, so the numbers are never accurate number, but these are the best estimate. Whenever there is a provision, you have to use the best estimate, right? Free from error via estimate. Use of reasonable estimate is essential. For example, useful life of PP&E, net realizable value of inventory, fair value of unlisted investment, expected credit loss. So these are what? These are the estimates, right? So best estimate is required. Best estimate is required to evaluate these kind of items. Okay. As long as estimates are fair, the financial statements are considered as a free from error even if actual outcome differs from the original estimate, right? So whenever there is an estimate, not necessarily the actual outcome will be same, it will differ, but you have to use the best estimate in measuring those kind of provisions. So friends, as we discussed, what is the fundamental qualitative characteristics? Information has to be relevant and information has to be represented faithfully. For considering it to be relevant, it has to be material, it provides predictive value as well as confirmatory value. And information has to be represented faithfully, right? It has to be substance over form concept has to be applied, it has to be complete, free from any error, and it has to be neutral, right? Okay, so friends, today let me clarify. Today, due to some urgencies, I will conclude my session by 9:30. Okay, I will conclude my session by 9:30, and it's 8:12 now. Let's have a 10 minutes break and we'll start at 8:22. Okay, so I'm taking a break right now and then we will start. Okay, Ashok ji, break start. Yes, so we discussed fundamental qualitative characteristics. Now we are going to discuss enhancing qualitative characteristics. What is meant by enhancing qualitative characteristics, right? So for a useful financial information or for making a financial information useful, right? The information has to be comparable, verifiable. The information has to be provided on a timely basis, right? And information has to be understandable. Okay. So comparability. Consistency helps, not same as uniformity. Comparability means the number has to be comparable. And how the number has to be comparable? In the first year, you have used the cost model. In the second year, you have used the revaluation model for PPME, for fixed asset. Whether the information is comparable, answer is no, right? Verifiability. Verifiability means the information has to be verifiable, right? For example, the company is into a fixed contract kind of a business. Fixed contract kind of a business, the company, okay? And the company, whatever revenue is there, for example, if the company is selling goods worth 100 rupees, 10% is the margin in which the company operates. In the current year, in the last year, the turnover was 1000 crores. The profit was roughly 100 crore. Okay. So it is not accurate. It has to be in line with. Okay. So 1000 crore was the turnover. Profit was 102 crore. So this year, the company's revenue was doubled. Okay. And it becomes 2000 crores. So the investors, bankers, and the lenders are expecting that this company has a 10% margin. So if that revenue is 2000 crore, the profit has to be more than 200 crores largely. Yes. So information has to be verifiable. Another example could be for an airline company, for example, the departures have increased. Departures have increased. If departures have increased, the passenger count have increased. So airport charges and the revenue both should have been increased. Okay. Both have should been increased. Means the information has to be verifiable. Okay. The information has to be verifiable. For example, the gross block, there is additions to the fixed assets. There is an addition to the fixed asset. Huge addition in the fixed asset. If there is a huge addition in the fixed asset, there has to be increase in depreciation also, right? And information has to be available within time to influence decision, because if a information which is very stale, if a information is very stale, it cannot be useful, right? Understandability. So it assumes reasonable business knowledge of the users, but information has to be understandable. It has to be in the acceptable language. The words and the jargons should not be the Shashi Tharoor kind of words and jargons. It has to be simple words and jargon. Okay. So on the classic example of timeliness, all these listed companies, they are required to publish their results on a quarterly basis within 45 days from the end of the quarter. Only for the year end, they have a timeline of 60 days from the end of the year. Okay. So friends, applying the fundamental qualitative characteristics, this part we have discussed. Talking about enhancing qualitative characteristics, there has to be comparability, means user's decision involved choosing between the alternatives. Information is more useful if it can be compared with similar info about other entity or the same entity in another period. Comparability means same entity, different period, okay, and other entity of the same sector, okay, other entity of the same sector. For example, if somebody has to invest in the petroleum stocks, in the oil marketing company stocks, whether they will go with the IOCL, BPCL or HPCL, okay. So comparability is not equal to uniformity, right? Consistency, same method for same item, is a mean to comparability, not the same as it, right? So how you achieve comparability? By applying the consistency, okay? By applying the consistency, right? So the information has to be comparable so that the analyst can compare the two companies' results in the same sector, or the analyst can compare the results of one company in the current year with the last year or the previous year. Verifiability, as I told you, the different knowledgeable independent observers can reach consensus, okay? Not necessarily complete agreement that a depiction is faithful representation. For example, direct, counting cash, indirect, verifying inputs to a model and recalculating outputs. For example, checking inventory quantity, cost and recomputing ending inventory using FIFO, right? Like the example I have taken, that the entity margin is 10%, right? So what is verifiability? Whatever is the revenue, it has to be nearly 10%. Like for airline, if the departures have increased, passenger has gone up, their airport charges should have been gone up and the revenue should have been gone up, right? For example, if gross block has increased, the depreciation has to be largely increased. So you are applying input and processing output, and you are reconciling whether that output is right or wrong. Okay. Timeliness. Okay. Information must be available in time to influence decisions. Okay. Older information is generally less useful. For example, report issued 6 months after year end lose most decision relevance for the current investment decisions. Understandability means classify, characterize, and present information clearly and concisely. Right? Some situations are complex and cannot be made easy. Excluding them would make report incomplete and misleading. Example or note: assume user have reasonable knowledge of business and economic activity and review information diligently. They may seek advisor for complex items. There are investors, there are analysts, there are lenders. So might be they're reaching out to some advisors for the complex items, but they're able to understand the normal and regular business informations in the financial statement. So friends, what we discussed in the qualitative characteristics while developing and drafting the standard, right? So in your general purpose financial statement, standards are required for general purpose financial statement. In the general purpose financial statement, the financial information has to be useful. For making the financial information useful, there are fundamental qualitative characteristics and enhancing qualitative characteristics. Fundamental qualitative characteristics is information has to be relevant and faithfully represented. Relevance means it can provide confirmatory value and predictive value, and it should be material enough. And for representing faithfully means substance over form. Information has to be complete, free from any bias. It has to be neutral. Okay. And enhancing qualitative characteristics means, right, a financial information can be enhanced. It can be enhanced if it is comparable, verifiable, it is provided within time, and it is understandable. Right? So now friends, the next part is financial statement objective and scope. What is the objective of the financial statement we discussed? The objective of the financial statement is to provide the information about the entity's resources, which is asset, claims, which is liabilities and equity, and the performance, which is income and expenses, and cash flow performance, as well as the shareholder performance also. And how this information is provided: balance sheet, profit and loss, statement of cash flow, statement of changes in equity, and notes to accounts, right? In balance sheet, it provides financial position. The balance sheet provides financial position. Okay. It provides financial performance. Okay. And it provides others provides liquidity performance, shareholder performance, funds performance, and the quantitative and qualitative disclosures. Okay. So the financial statement has to be prepared for a reporting period. A reporting period is at least 1 year, right? If it is a listed company, listed companies are publishing the results on a quarterly basis, but on a yearly basis, they are preparing full-fledged financial statement. Okay, right? So the financial statement has to be prepared from the entity perspective, not from the user perspective. Not from the user perspective means the financial statement should not be prepared in a manner to please a single set of investor or a particular category of investor. It has to be prepared in a manner that it will complete all, it will cover all the required information. It will be faithfully represented, and it provides the information about the company's resources and claims, provide the financial performance, provide the liquidity performance, shareholder performance, and the quantitative and qualitative disclosure. The financial statement has to be prepared on a going concern basis. It has to be prepared on a going concern basis. Going concern means assuming on the reporting date, assuming the business, the entity will run in the foreseeable future. Foreseeable future means 12 months. Foreseeable future means 12 months. Okay. Foreseeable future means 12 months. Okay. The reporting entity. The reporting entity. What is meant by reporting entity? Very simple. You all are aware. Reporting entity is an entity which is required or which prepare the financial statement, right? It can be a single entity, a portion of an entity, or comprise more than one entity. A reporting entity is not necessarily a legal entity. For example, if a branch is publishing, a branch is there is a branch in China, and that branch is also required to file their financial statement in China with the Chinese authority. So that can be a reporting entity. But normally, typically, a reporting entity is just like a legal entity, which present the consolidated financial statement, standalone financial statement, right? So what is a standalone financial statement? What is a consolidated financial? These two are relevant, right? What is a consolidated financial statement? What is standalone financial statement? Standalone financial statement means separate financial statement. You know, standalone means the entities, the parent financial statement, and the subsidiaries, associate, and joint venture financial statement. Okay. What are the elements of the financial statement? Friends, you remember component we discussed. Now we discussed element also. There are 5 elements, 3 from the balance sheet. These 3 elements are the balance sheet elements. The last 2 elements are the P&L elements. Any transaction you think about, for example, you purchase a ticket for a Dhurandhar movie show. You spent 500 rupees. What is that? That is the expenses. The money you spent is expenses and cash has gone out. Okay. You purchased a car by taking a loan. Car is an asset, loan is a liability. Okay. Think about any commercial transaction. It will get fitted into these 5 elements of the financial statement. Asset. What is meant by asset? Asset is an economic resource. Why I am using the word economic? Have you heard the word? In your office, your boss must have told you, you are a good resource. You are a good resource. Are you an economic resource? You are a good resource. You are a human being, right? An asset is an economic resource, means economic means which can provide some benefit. Okay. Sir, we can also provide some benefit, but you are a human being. Okay. So an asset is an economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits. For example, machinery. So machine is an economic resource which has a right. So machine is an economic resource means it is a right which has a potential to produce output. Okay. So what is the economic resource? It is a right that has the potential to produce the economic benefit. Okay. So asset is a resource controlled by the entity. Asset is an economic resource controlled by the entity as a result of past event. Example of the asset could be machinery, car, vehicle, right? Intangible asset, investment property, trade receivable, investments. These are example of cash and cash equivalent, bank balance, fixed deposit. These are example of asset. Liability. What is a liability? Liability is a claims, right? It's an obligation. Liability is an obligation. Asset is a resource. Asset is a resource. And liability is a obligation, right? Asset is a resource. Asset is a right. And liability is an obligation. Okay. Liability is a claim. It's an obligation. A present obligation of the entity to transfer an economic resource as a result of past event. In the past, the company has purchased a raw material on a credit basis. So since the company purchased the raw material on credit basis, the company is presently obligated to transfer the economic resource, which is cash, which is bank, right? So this is the definition of liability. What is equity? Equity is always a residual interest. Residual interest. Equity. The residual interest in the asset of the entity after deducting all its liabilities. So I was the shareholder of Satyam, right? So I still remember it was 26 September or 28 September 2008. I purchased shares of Satyam. Satyam was a good big IT company. So due to the accounting fraud, so their share price have collapsed and Satyam was kind of collapsed. So I purchased the share at that point of time at 200 rupees per share. 100 shares I purchased at that point of time. Just in few days, on 28 September, it went down to 11 rupee. So friends, equity shareholders are the residual. They are the last. If the company will become bankrupt, insolvent, if something will be left after settling all the liabilities, if something will be left, it will be distributed among equity shareholders. Normally, nothing. You can say that, right? So equity is a residual interest in the asset of the entity after deducting all the liability. What is the income? It is increase in assets or decrease in liability. When the assets are increasing or liability is decreasing, right? It is considered as a income that result in increase in equity other than those relating to the equity contribution from holder of equity claims. What does it mean? So what is the income? Income is an increase in asset or decrease in liability, okay, due to a transaction from the parties who are not the shareholders, who are not the equity providers. For example, the company has done a right issue, right? Due to right issue, there will be increase in asset because bank will be increased, right? Increase in assets. Asset to increase होगा ना right issue से. But whether this transaction is with shareholder or other than shareholder, this transaction is with shareholder. So this will not be considered as an income. This will be considered as an equity transactions. Vice versa, expense are reverse. Decrease in assets or increase in liability, right? Arising from a transaction which is not happening with the shareholder. For example, dividend. Dividend paid. So by paying a dividend, your asset will be decreased. But it is a transaction with shareholder or other than shareholder? With shareholder. So it is not meeting the definition of expense. Sir, what is the definition of expense then? Example, interest cost on the borrowings. By paying the interest on borrowing, whether your asset will be decreased, yes, your cash balance will decrease. Is it a transaction with shareholder? No, this is a transaction with banker. Yes, okay, it is a expense. It is a expense, right? So these are the definition: asset, liability, equity, income, and expense. So there are three key aspects of any asset. There must be a right. Okay, there has to be a right to receive. Okay. So there has to be potential to produce economic benefits and there has to be control. An asset is an economic resource, right? An asset is an economic resource. And what is an economic resource? Economic resource is a right. An asset is an economic resource, right, which has a potential to produce economic benefits, right? So an asset is a resource which provides a future economic benefits, right, as a past of the, which provides a control as a result of the past event, okay? Future economic benefits and where the entity has a control, whether entity has a control, okay? Rights that do not constitute assets. Which are those kind of right which do not constitute the assets? Rights available to all parties without significant cost. For example, public right of way, know-how in public domain, okay? Right, public right of way. So you are using roads, you are using the public infrastructure, right? So government has given a right to free Wi-Fi on the airport. Can you have the right? You can use that free Wi-Fi, and by using the free Wi-Fi, you went to the airport 3 hours prior to departure, and you are doing all your office work using the airport Wi-Fi, right? So whether you will capitalize that as an intangible asset, right to use Wi-Fi? Answer is no. Okay. Treasury shares. An entity cannot have a right to obtain benefit from itself. What are the treasury shares? Companies own shares. You will read this in dash 32. Companies own shares which are held for cancellations. Okay. Debt, so treasury shares are never an asset. It has to be shown as a part of the equity. It has to be shown as a reduction from the equity. Debt or equity instrument of one legal entity within a reporting entity held by another legal entity within the same reporting entity. Okay. So debt or equity instruments. Examples. Unit of account. For example, land. Ownership of land gives the entity multiple rights. Right to use, right to sell, right to give on lease, right to place as security for loans, etc. However, these rights are normally bundled as a single asset. So there are multiple unit of rights, but this has to be considered as an economic right, economic resource. Okay. So this right has been collated as an asset, which is land. So bundled as a single asset land, as such classification provides a faithful representation of those rights in the most concise and understandable way. When you say land under property, plant and equipment, somebody can understand. It is your land, you can sell, you can lease, you can use, you can just let it as it is. Existence uncertainty. An entity and another party might dispute whether the entity has a right to receive an economic resource from that other party until their existence uncertainty is resolved. For example, by a court ruling, it is uncertain whether the entity has a right and consequently whether an asset exists. For example, contingent asset. When you read Ind AS 37, it says that an asset will be considered as a contingent if it is probable that the benefits will be received, right? For example, insurance claim, right? Insurance claim will be disclosed as a contingent asset if there are more than 50% chances that the benefits will be received. But if it is virtually certain that the benefit will be received, it will be classified, it will be recognized as an asset. It will be recognized as an asset. My dear friends, so if there is an uncertainty, for example, if there is an uncertainty, right? If there is an uncertainty, if there is an uncertainty, okay, that the insurance claim may not be received, means it is not virtually certain. You cannot recognize and measure this as an asset, okay? You cannot recognize and measure this as an asset. Is that clear? Is that clear, my dear friends? Great. Now, another example. Low probability still an asset exists. So while there is a low probability to recover, but whether it will be considered as an asset, the company has sold goods to a customer on a credit basis. The customer become bankrupt and the company is pursuing through a court of law. So while the company will, let's say there is 100 crore rupees of 100 rupee of trade receivable and the customer becomes bankrupt. So the company will disclose it as a provision for doubtful debt 100, right? Provision for doubtful debt 100. And it has to be nil. Provision for doubtful debt 100 and it has to be nil. Okay. But whether the company will show it as an asset, answer is yes. The company is not losing the right. Might be the measurement could be nil, but the company's right has not been foregone. Right? So when if that company which becomes bankrupt, if the liquidator will sell the assets of the company, if something will left, it will be provided to the entity. Okay. So a receivable from a bankrupt customer is a right and hence still meet the definition of an asset, even if the measurement principle, that is expected credit loss, provision for doubtful debt, renders the net carrying amount as nil. So net carrying amount could be nil in the balance sheet, but you have to show it as a gross value of trade receivable less provision for doubtful debt. Okay. The definition is not driven by probability, recognition and measurement are, right? So the definition does not say that you are not able to recover, it means it is not a right. It is a right. The only thing is, if you are not able to recover, you have to measure it as nil. Okay. What is liability? Liability is an obligation, right? Where, so obligation, present obligation. Okay. So it could be a legal obligation, it could be a constructive obligation. Legal obligation means contractual. Constructive obligation means legal obligation means contractual. Constructive obligation means due to a customary practices, published policies, specific statements, etc., etc. Okay. So it could be a legal obligation, it could be a constructive obligation of transfer of economic resources, right? Transfer of economic resources means either you end up settling by payment of cash. Creditor, creditor is a liability. Why it is shown as a creditor? Because you in the past you have purchased some goods and services on the credit. Now you have to settle. Either you have to exchange in terms of some asset, or you have to pay cash in bank, right? It is a contractual obligation. Okay. What is a constructive obligation? For example, the company the company is emitting a lot of carbon emissions through its chimneys. There is no environmental legislation in the state, but company says that for every cubic meter of the carbon emission, for every cubic unit of the carbon emission, we will compensate the environment. We will plant the trees, or we will deposit money in the environmental authorities worth XXX rupees. And the company made this policy and published on the website. The company made this policy and published on the website. Okay. Friends, while there is no environmental legislation, nobody will come from the environment department, and nobody will claim the penalty and fines. But the company has made a policy and published on the website. So it means company is promising to compensate it, the damage to the environment. So let's say there is a 1 lakh cubic unit of environmental pollution, and the company has not created any provision, or company has not spent any money, right? So going by the concept of constructive obligation, right, the company has to make a provision of that amount. So whether it is an obligation, it's a constructive obligation. Whether it is arising out of the past event is damaging the environment, right? And whether there will be a transfer of economic resources, yes. When the company will pay a cash, there will be transfer of economic resources, right? So friends, there is a concept of executory contract. What is meant by executory contract? You will read in Ind AS 37. See, in every aspect I am telling you some name of the standard. Okay. So you can relate this conceptual framework. All these concepts are there to build the standard. What is meant by executory contract? Executory contract means a contract where either neither party has performed the obligation, or both the parties have performed the obligation, or the parties have equally performed the obligation. Okay. For example, you are a chartered accountant. You got a contract from a company to file the GST returns for every quarter. And there is a 25,000 rupees which is payable every quarter. In the first quarter, you have not filed the return and the customer has not paid the money to you. So neither you have performed your obligation nor that customer has performed their obligation, right? Or you have performed your obligation, you filed your quarter one return, the customer will pay you the quarter one amount. So the customer will make a provision for quarter one 25,000 rupees. So executory contract means where both the entity has equally performed their obligation or not performed their obligation, right? Example of constructive obligation we have discussed: environmental policy. Equity is a residual interest we discussed. Income we discussed. Increase in asset, decrease in liability with the transaction other than shareholder. Expenses, decrease in asset, increase in liability with the transactions from the party other than shareholders. Okay. Now the recognition. What is meant by recognition? Recognition means capturing that item or including that item in the balance sheet or P&L, right? In the component of the financial statement. Okay. So you spent 1 lakh rupee in purchasing chairs. What is chair? Furniture. Now how it is going to be recognized? Either it has to be recognized as an asset in the balance sheet or as an expense, right? So recognition means a process of capturing or including that item in the balance sheet or the statement of profit and loss, right? an item which meet the definition of one of the element of the financial statement: asset, liability, equity, income, or expenses, right? See, your two primary component is balance sheet and P&L. See, you have a journal entry, journal entry getting transformed into the ledger balance. From the ledger balance, there is a trial balance, From the trial balance, you will prepare your financial statement. In the financial statement, from your trial balance, you will prepare balance sheet and P&L. Your statement of changes in equity, cash flow statement, notes to accounts, these are the culmination from your balance sheet and P&L. Okay, right? So whatever you are recognized in the balance sheet is known as a carrying amount. You know, now balance sheet numbers have to be carried forward. P&L numbers are not required to be carried forward, right? If Tata Steel has purchased a land in Jamshedpur in 1910, it will come into the balance sheet of 2026 also if that land has not been derecognized, if that land has not been sold out. Okay. So what is the recognition link between the balance sheet, P&L and equity? So in the opening balance sheet, there has to be asset. On the one side, there has to be asset. On the other side, there has been equity and liability. So asset minus liability is equal to equity, accounting equation. You have learned in class 11th. So for example, there is a asset minus liability is equal to equity net. There is a retained earning. Okay. Then there is a P&L. In the P&L, there is income minus expenses equal to profit. This profit will go to retained earnings, right? In your closing balance sheet, your net equity will change. So your opening balance sheet to closing balance sheet, it will be changed from two items. Number one, through statement of P&L, right? Income, expenses, profit. Through other equity changes, for example, dividend paid, right issue, revaluation surplus, right? So these items are not coming in P&L, but these items are other equity changes. Through other equity changes also, your closing balance sheet numbers will get changed. Your equity will get changed. Your asset liability will get changed. Okay. So this is the linking. This is just giving us a linking, right? Recognition of income. You need to credit income and debit asset, or debit asset, right? Or you need to credit income, debit liability, right? Means liability is decreasing, means income is coming. Your asset is increasing, asset is getting debited, means your income is coming. Or it could be debit liability, derecognize or the carrying amount, recognizing the carrying amount. Recognition of expense, expense account debit to bank, right? Credit asset, or bank account debit to liability, for example, right? So recognition criteria, you have to recognize an asset and liability in a manner, right, that it provides the it meets the qualitative characteristics, right? Fundamental qualitative characteristics means the information has to be relevant and it has to be faithfully represented. It has to be faithfully represented. Okay. Now, recognition का उल्टा derecognition. Derecognition. What is meant by derecognition? Recognition means capturing or including an item, an element, an item in the balance sheet or statement of profit and loss. What is meant by derecognition? Removing all or part of a recognized asset or liability from the balance sheet. Derecognition never happens in the P&L. Remember, what is going to be derecognized? Something which is recognized in the balance sheet, right? Something which is coming in the balance sheet is derecognized. So derecognition occurs when the item no longer meet the definition of an asset, right? For example, loss of control, or of a liability no longer has a present obligation. For example, the company has purchased a machinery from China for rupees 1 crore. The company has purchased a machine. Machine is a property, plant and equipment. The company will recognize as an asset. The moment machine came to India, government has banned the output produced from such machineries. Friends, will that machinery meet the definition of an asset? Whether this machinery is an economic resource which gives a right to provide a future economic benefit, Whether company has a control over this machinery to use it at its own whims and fancies? Answer is no. So while this is a brand new machinery, this is lying with the company, but whatever money the company has spent, the company will de-recognize it. The company will de-recognize it. Or another example, the company has a truck. The company has capitalized the truck as a property, plant and equipment. The company was using the truck, the company was running the truck beautifully. After 3 years, the truck met with an accident, right? The driver saved because the truck, after 3 years, the truck was, flowing in, the truck was running towards a bridge, and due to imbalance, the driver jumped and the truck fell into the river. The truck was completely damaged, right? So it is not repairable at all, friends. While this truck which met with an accident and not repairable, completely damaged, whether the company will still continue to recognize this truck and continue to depreciate in its balance sheet year on year? Answer is no. Now the company has lose the control. The company will not be able to get any benefit. The company will de-recognize the truck. Okay. Or the company will de-recognize the liability if it does not have a present obligation. For example, the company has taken a loan from a bank at 10% rate of interest. The loan amount is 1 crore. So the company has paid the interest for first year, which is 10 lakh rupee. In the second year, due to the cash crunch with the company was not able to pay the interest in the second year. The carrying amount of the liability loan is 1 crore 10 lakh, 1 crore principal, 10 lakh rupee this year interest. Another year, the company has not been able to pay the interest. In the second year, again 10 lakh rupee, for example. So the closing balance of the liability carrying amount is 1 crore 20 lakh. The company has recognized it in the balance sheet of that year end. Subsequently, the company spoke to the bank and company requested that I am running into a huge financial crunch. It will be great if you can waive the interest of the last 2 years. I will continue to pay in the future years. The bank has agreed to waive the interest and bank has given an approval for the waiver of the past 2-year interest. Friends, the company has shown a liability of 1 crore 20 lakh. Now, this 20 lakh rupee interest, whether the company will de-recognize or not de-recognize, the company will de-recognize. So the company will partly de-recognize the liability. Okay. The company will partly de-recognize the liability. Or, for example, the loan has been taken by the farmer. The new government came and waived all the liability of the farmer. So the liability has to be removed. Okay. So you have to de-recognize it. Okay. You have to de-recognize it. Is that clear? So let's take an example from the ICAI Board of Studies material. As on 31st March 20X2, Natasha Limited, this is the name of the company, carries trade receivable of 280 crores. Carries trade receivable of 280 crores. It enters a factoring agreement with Samantha Limited, a financial institution, right? So as at 31st March, Natasha Limited carries trade receivable of 280 crores. It enters into a factoring agreement with Samantha Limited, a financial institution, transfer the receivable in exchange for an immediate cash payment of 250 crore. So it is known as a factoring, right? Have you heard about the word factoring? Factoring means you are selling your receivables to a recovery agent. I don't know if you are aware or if you have heard. So bankers used to do this. There is a recovery department of the bank. They engaged the goons and the bouncers and the recovery agents who can give a lot of French, who can abuse, who can shout. Okay. So what they do for all the old recoveries, they sell these recoveries amounts from the borrowers or defaulters to these recovery agents at 20%, 30%, 40%, right? So likewise, this company has a trade receivables of 280 crores. This company has sold these trade receivables to a recovery agent for 250 crore. Any shortfall between amount collected and 250 crores will be reimbursed by Natasha to Samantha. So while it seems like the 280 crore receivable has been paid to has been given to the recovery agent in collection of 250 crores, but the recovery agent told, listen, whatever I will receive in in addition to 250 crore, that is mine. But if I will recover less than 250 crore, the differential has to be reimbursed by you. This Natasha Limited said, okay. Any excess over 250 crore, less interest repaid to Natasha. Acha. So it is saying that any excess over 250 crore, less interest. Okay. So they will charge interest, but any excess over 250 crore excluding interest will be repaid to Natasha. So any shortfall has to be reimbursed by Natasha. Any excess has to be taken by Natasha. Directors of Natasha propose to de-recognize the receivables. Directors of Natasha propose to de-recognize the receivables. Okay. Now, you have to analyze using the conceptual framework in Ind AS 109 whether you need to de-recognize or not. Conceptual right to cash flows expired. Whether conceptual right to cash flows expired in the books of Natasha? No. Why? Receivable still exists in the books and are expected to be collected. I told you, na, the right has not been expired. The measurement could be less than the carrying amount. For that, you need to carry a provision. But the contractual right still exists. The moment Natasha has transferred this to Samantha, the right has not expired, right? Because when Samantha will recover, in addition to 250 crores, Samantha will repay to Natasha, na? Whether transferred substantially all risk and rewards? No. Natasha still remain liable for any shortfall and receive excess collection. So credit risk retained and reward also retained. Framework. Whether control lost? No. Natasha retain exposure to significant positive or negative variation in economic benefit, still control the asset. Conclusion. Do not de-recognize. Recognize 250 crore received Samantha as a financial liability. So Natasha has to still continue to recognize trade receivable at 280 crore less provision for doubtful debt, right? सर ये तो पहले ही इन्होंने प्रोविजन फॉर डाउटफुल डेट बना लिया होगा, तभी तो ये रिकवरी एजेंट को पैसे दिए हैं, मतलब पैसे मिल नहीं रहे थे. एंड जो समानता से रिकवर किया वो फाइनेंशियल लायबिलिटी 250 करोड़. ओके, राइट. So the framework says about this, Ind AS 109 says about this. Okay. Now let's come to the measurement, guys. So guys, what we learned so far in these 6 chapters, what we learned the introduction of the framework, objective of the general purpose financial reporting, fundamental qualitative characteristics and enhancing qualitative characteristics, the component of the financial statement, meaning of reporting entity, element of the financial statement, recognition and de-recognition. Now we are going to cover measurement, presentation and disclosure. What is the measurement? There are 2 categories of measurement, historical cost and current value. Let's understand it with a small example. Your grandfather has purchased a land 80 years ago. The cost of the land was 1 lakh rupee. 80 years ago, your grandfather has purchased 5 acres of land at 1 lakh rupee. 80 years ago. Now the value of the land is 100 crore rupees. Tell me, what is historical cost? What is current value? Historical cost is 1 lakh. Current value is 100 crores. Current value is 100 crores, right? So friends, when we talk about measurement, once we recognize the asset, now we have to measure it, right? To capture into the books of accounts. So the measurement basis is an identified feature, for example, historical cost, fair value of an item being measured. Applying a measurement basis create a measure for the asset or liability and income and expenses. There are 2 types of measurement basis. Historical cost, like I took an example. Historical cost means it derived from the price of the transaction or event that gave rise to them. Entry value. When you entered into that transaction 100 years ago, 80 years ago, 5 years ago, 2 years ago, 3 months ago, what was the value? That is known as a historical cost. Okay. Not updated for value changes except for impairment, onerous liability, interest accrual, consumption. So the market value has changed, but you have not changed the value and you are showing it at a book value, historical cost, right? You must have seen in the accounting policy section of the financial statement that the assets have been presented at historical cost basis. So this historical cost will be changed only by the depreciation, impairment, right? But it will not be affected by the revaluation, change in market value, no. Okay. So historical cost pretty simple. In our accounting standard, a lot of places we were using only historical cost, but in Ind AS, there is a heavy use of fair value also. What is current value? Current value means aaj ki value, market ki value, fair value, current value, right? Means how market value this asset or liability. Then value in use, right? Value in use for asset, fulfillment value for liability. What is meant by value in use? For example, you have an asset. So you have two options. Either you can sell the asset. For example, you have an asset. So how you will get the benefit from the asset? How you will get the benefit from the asset? Either by sell or by use. When you get the benefit by sell means market value, fair value, right? So measuring the benefits by selling the asset is covered under fair value. Measuring the benefits by using the asset is covered under value in use. Means if you use the asset, what are the expected cash flows in future? When you discount those future cash flows, what is the total value which you are getting? That is known as a value in use. Or what is meant by fulfillment value? For example, liability. The liability is 100 crores, but you know that the actual payment has to happen for 80 lakh rupee only, right? So 80 lakh rupee is the fulfillment value of the liability. Current cost, what is meant by current cost, right? Cost could be different than market value also. Current cost means entry value at the measurement date. If I replace, I have a raw material, I purchased at 60 rupee per kg. The today's value of the raw material, if I am going to purchase it, so it will cost me, let's say 80 rupee. I purchased at 60 rupee. So current cost is known as a replacement cost. Okay. How it is different from fair value? So current cost is more like a replacement cost. In the fair value, the margins may be inbuilt, okay, from the market participant perspective. Okay. So friends, as we discussed, for assets and liabilities, asset has to be recognized at whatever you paid plus directly attributable cost, right? For example, you purchased a building. The cost is 20 crore and stamp duty, registration charges is 2 crore. So the cost of the asset is 22 crore, right? 22 crore. Okay. What is the value of the liability? You took 100 crores. Okay. Consideration received, and you also paid transaction cost also. So your liability will be net of that. Means you have to apply effective interest rate method. Okay. Technically speaking, let's say 100 crore borrowings you have taken, 100 crores borrowing. Okay. Less, there is a processing fee of 10 crore. What you get? You get 90 crore. Effectively, you get a 90 crore. You get a 90 crore rupees, but what is the principal amount? 100 crore. See, please understand. Today, you receive 90 crore net from the bank. Bank account debit to loan account 90 crore. But after 5 years, you have to pay 100 crore rupees plus interest. Let's say the repayment, after a certain period of time, the repayment will be 100 crore. After, let's say 3 years. So it means in 3 years, you have to pay 20 crore as an interest. So your effective interest rate will go up. This 90 crore this interest will be added back to the 90 crore, and at the end of the year, it will become 110 crore, right? So the liability has to be recognized at consideration received, right, minus transaction cost. Okay, clear? So your current value is fair value more from the market participant perspective. Your value in use is more from the entity perspective, and current cost is more like the entry value, replacement cost. Okay. So again, while applying a measurement basis, right? So whatever measurement basis you're applying, it has to be relevant and it has to be faithfully represented. Okay. The amount has to be comparable, understandable, and verifiable. Okay, right? If more than one measurement basis, right? So more than one measurement basis plus measurement of equity, for example, off-market transaction, a parent provides an interest-free loan to its subsidiary, an off-market transaction. So in the parent book, this subsidiary loan has to be recognized at fair value. Okay. So there could be a chances where, for example, more than one basis, fair value through OCI. There is an interest-bearing financial asset measured at fair value through OCI. So P&L, interest income at amortized cost basis, OCI, the fair value changes has to be captured. So friends, you will be able to understand when you read financial instrument, right? So these are the conceptual framework concept which you will actually see in the standards. Okay, in the standards. Talking about presentation and disclosure, so it's more like a communication tool of financial statement. There should be a balance between the flexibility to provide relevant, faithfully represented information and requiring information which is comparable both from period to period within an entity and across an entity within the sector. Friends, the information has to be properly classified, information has to be aggregated properly and offsetted, right? Properly classified means like in the P&L, like in P&L, your expenses has been classified on nature basis, You remember in the day one I have covered a removal of option, the nature based classification of expenses. In balance sheet, your assets and liabilities are classified into current and non-current, right? So the classification has to be consistent and proper. Aggregation, all the like items needs to be aggregated. All the immaterial items needs to be aggregated and shown as a single item. Offsetting, you have to recognize your assets and liability as a separate unit of account. But when the offsetting provides more relevant and more faithful representation of the information, it has to be offsetted. Classic example is deferred tax asset and deferred tax liability. It has to be offsetted and shown as a single line item. Okay. So presentation and disclosure is like you need to provide a disclosure to provide the disclosure has to be qualitative and quantitative. Okay, qualitative and quantitative. The last concept is concept of capital and capital maintenance. Friends, there are two kind of capital maintenance: financial capital maintenance and physical capital maintenance, right? So normally, you remember I started with an example. Your salary in the last year was 10 lakh rupee. This year your salary is 11 lakh rupee. This year your salary is 11 lakh rupee, right? But the inflation is 12%. So you are enjoying, you are happy that, my salary is increased by 10%, it increased by 1 lakh rupee. But are you able to live your life in a same manner in which you are living till the last year? Your expenses has been inflated in the more ratio, in the more proportion in comparison to your hike in the income, right? Hike in the income. So friends, it means, so if we will look one side of it, seemingly we have earned a profit. But if we will look with the environment, with the inflation, so it means we are not generating a profit. Are you getting me what I'm saying? So the concept of capital and capital maintenance is that, so if 10 becomes 11, probably you have increased your capital, but are you able to maintain your capital? So that is kind of the concept which framework talks about. And this is the only area where a practical question may be asked. So it says that profit is earned only after capital has been maintained. The concept of capital and the concept of capital maintenance together determine profit. How it determine? Let me tell you. So first let's talk about financial capital maintenance. It says that profit is earned only if the financial or money amount of net assets at the end is greater than at the beginning, excluding owner contribution and distribution. It says that The profit will be considered as earned only if the financial or monetary amount of net assets at the end is greater than at the beginning, excluding honor contribution or distribution. Measurement measured in nominal monetary unit or unit of constant purchasing power. I will discuss with the help of an example. Nominal means all price increases, right? Holding gains are profit. Constant purchasing power means only that part of price increase exceeding general inflation is profit. The rest is a capital maintenance adjustment part of equity. What is physical capital maintenance? Profit is earned only if the physical productive capacity or operating capability at the end is greater than at the beginning, excluding honor contribution and distribution. Measurement requires a replacement cost measurement basis. All price changes, if affecting assets or liabilities, are viewed as changes in the physical productive capacity. सर कुछ समझ नहीं आया, मेरे को भी नहीं आया. Let's understand this with the help of an example, right? There is an entity. The entity has 6,000 units at 2 rupee per unit. Okay. Sales at 3 rupee per unit, withdraw 6,000 rupees. Okay. So the entity has invested, the entity has purchased 6,000 unit of a product at 2 rupee per unit. What is the opening capital? What is the net equity? 6,000 multiplied by 2, 12,000 rupees, right? Opening capital is 12,000 rupees. The company sold all 6,000 units at 3. What is the cash they have generated? 18,000 rupees. So opening capital is 12,000 rupees. Okay. The cash they have generated is 18,000 rupees. 18,000 rupees. So means for 12,000 they got 18,000. But there are 6,000 rupees of drawings. There are 6,000 rupees of drawings. Okay. Means whatever additional 6,000 was there, it was withdrawn. Okay. The closing cash is still 12,000. The general price index is 100 becomes 120. The product price has been increased from 2 to 2 rupee 50 paisa. A specific index 125. Right. So if I go by the nominal, monetary unit approach, and I'm maintaining my financial capital at the historical cost. Okay. So my closing capital is 12,000 only because 18 minus 6, 12,000. My opening capital to be maintained is 12,000 rupees, right? And my retained profit or loss is how much? My retained profit or loss is how much? This is कितना है retained profit or loss? कितना है? 12,000 रुपए में रिटेन कर पाया, 12,000 रुपए, and should have restricted drawing to 6,000 rupees as done. Means, so to cut a long story short, if I am going by a nominal approach, if my opening equity is 12,000, what should be my closing equity when I can say that I have maintained my capital at historical cost? 12,000 rupees, as simple as that. अगर मेरी कैपिटल शुरू में भी 12,000 थी और आज भी 12,000 है, तो मैं क्या बोल सकता हूं कि मैंने हिस्टोरिकल कॉस्ट अप्रोच पे अपनी कैपिटल को मेंटेन कर लिया. But for example, if this drawing would have been 8,000 rupees, then my closing capital would have been 10,000 rupees. Then I can say that even going by the historical cost, I was not able to maintain my capital. I missed my capital maintenance by 2,000 rupees. Have you understood it? So going by the historical cost approach, you have to maintain your capital at least to the level of the opening capital. Now, going by the constant purchasing power, right? Going by the constant purchasing power. I purchased my 6,000 units at 2 rupee per unit. I purchased my 6,000 unit at 2 rupee per unit. At 2 rupee per unit. Okay. At 2 rupee per unit. Okay. So friends, so in 12,000 rupees of capital, I was able to purchase 6,000 quantity. But friends, now there is a 20% of inflation. There is a 20% of inflation. Means this 2 rupee product become 2.4, for example. So friends, tell me how much money I should need. How much money I should need to purchase the equivalent quantities at the current price, at the current inflation. So 6,000 quantity multiply by 2 multiply by 120%, right? So it will come at 14,400. So how much opening capital I need to maintain to 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 maintain my financial capital at the constant purchasing power? What is meant by constant purchasing power? Constant purchasing power means, are you able to maintain your capital in a way that you are constantly able to purchase equivalent number of quantity? Are you getting me? Are you getting me, my dear friends? Are you getting me? You are able to purchase equivalent number of quantity. Means for maintaining my capital, I need 14,400 rupee, right, to purchase 6,000 quantity, But how much capital I have? 12,000 rupees is the closing cash. It means I lost 2,400 rupee going by the constant purchasing power methodology. Constant by purchasing power methodology. Okay. Historical cost means you are not worry about inflation or anything. You're just looking at whether 12,000 is 12,000. Okay. But in constant purchasing power, you are looking at a quantity. Here, you are looking at the amount. Here, you are looking at the quantity. Okay. Is that clear? Is that clear? So in this case, to maintain my capital of 14,400, I have to restrict my drawings to 3,600. Is that clear? Now coming to the physical capital maintenance. What is meant by physical capital maintenance? While the inflation is 20% high, but now my product price become 2.5. The specific index of that commodity has been 25%. So tell me, if I have to maintain my physical capital, okay, same physical capital means quantity, again quantity. So I need 15,000 rupees, 6,000 multiplied by 2.5. 15,000 rupee I need 15,000 rupee I need 15,000 rupee I need for maintaining my capital, for purchasing my goods, right? And my dear friends, tell me, how much is my closing capital? How much is my closing capital? How much is my closing capital? My closing capital is how much? If you see, 12,000 was my opening capital. I received 18,000 rupees, right? I received 18,000 rupees. Okay. And my borrowings were 6,000 rupees. Out of this, my borrowings were 6,000 rupees. So I have only 12,000 rupees. But in this 12,000 rupees, so 25% price index have been increased by 25%. Means this 12,000 closing capital is worth of 9,000 rupees only. Are you getting me? Are you getting me what I'm saying? I am left with 12,000 rupees, right? But my purchasing power has been down by 25%, right? So my cash after adjusting cost stock at current cost only coming at 9,000 rupees. It means I have lost 6,000 rupees of borrowings. 6,000 rupees of borrowings I have lost. So basically, sorry, I have lost 6,000 rupees. And if I have to restrict, I have to maintain my physical capital, my borrowing should be nil. My borrowing should be nil, right? No drawing is possible. No drawing. So physical requires maintaining productive capacity. So physical capital only always requires maintaining a productive capacity. So how much amount I need for buying 6,000 and 15,000 rupees? 15,000 rupees. And how much I have? 12,000 rupees. How much shortage I have? 3,000 rupees of shortage I have. Okay. What are the key takeaways, my dear friends? We have discussed the conceptual framework is a constitution of Ind AS. It is not a standard and does not override Ind AS. The objective of general purpose financial reporting is to provide a decision making, right? A useful information to the investor, lender, and other creditors. General purpose financial reporting does not show the value of the entity. They help user estimate it. There are fundamental qualitative characteristics, which is relevance plus faithful representation. Relevance include having a predictive value, confirmatory value, materiality. Faithful representation includes your comparability, verifiability. Okay, sorry. Faithful representation includes faithful representation includes your substance over form. Okay, free from error, complete, neutral, and enhancing qualitative characteristics is comparability, verifiability, timeliness. Okay, these are the enhancing qualitative characteristics. Materiality is entity specific. Asset means a right to receive the potential benefits and where there is a control over the entity, and this potential benefit could be a small probability also. Liability is an obligation, present obligation to transfer the resource as a result of past events. Recognition means including or capturing the item in the financial statement which is largely in balance sheet and P&L. Derecognition means derecognizing an asset when the control is lost or the liability when no longer it is a present obligation. There are measurement bases which is historical cost versus current cost, right? And the capital maintenance, we discussed the financial capital maintenance which is nominal historical cost and which is constant purchasing power, on the basis of constant purchasing power versus physical capacity. Okay. So quickly discuss some MCQs. Which of the following is true about the conceptual framework under Ind AS? It is an accounting standard. It sets out concepts, right? It sets out the concept underlying financial reporting. Nothing in it override any Ind AS. Only apply to listed company, only apply to public sector entity. B is the right answer. The primary user of general purpose financial report includes management, regulator and member, existing and potential investor, lender and other creditor, equity shareholder, employee. B is the right answer. Yes. Which characteristics makes information relevant under the framework? Audit, predictive value, confirmatory value, or both. Monetary unit, compare with peer companies. This one. Okay. Under the revised framework, an asset is a resource that will produce future economic benefit. A present economic resource controlled by the entity as a result of past event. Any resource owned by the entity. Resource which is likely to generate cash flows. Again, B is the right answer. Okay. So friends, these are the kind of MCQs which are there. As per the framework, when can a right be recognized an asset? Only when the probability of economic benefit is probable. No. Only when it is virtually certain. No. Right. Even if the probability of producing economic benefit is low. Yes. Only if the entity has legal ownership of the resource. No. A contract requiring an entity to pay salary in return for future employee service where neither party has yet performed is a recognized liability at the salary amount. Executory contract. Okay. Not a contingent asset, not a financial liability. Friends, there are 4 more questions and I have given the answer to all the questions. As discussed, due to some urgency, I need to conclude the session. So the remaining 4 MCQ, I have already shared this material. The remaining 4 MCQ you can solve. The answer with the relevant explanation has been given here, right? So thank you so much. And with this, I hope you have enjoyed this conceptual framework of financial reporting. I am concluding this session. Thank you so much. Thank you, Ashok ji. Thank you, Ajit ji. Yeah, you can conclude the session.